Hi there, welcome to the channel. So today I want to go through a little of analysis of the fundamentals of Affirm Corporation. So what is this company? Okay, this company is one of these buy now, pay later companies. So if I go to their website, how it works here, you can see that there's a couple different things here. First of all, you can go to places that participate with them. And when you go to buy something, they have this little button here that says, well, use your credit card or you could use Affirm, where you pay over time. And then over here, they kind of show that like, okay, they'll offer you different options, 3 months, 6 months, in different amounts of interest. So I assume that this would be based on your credit. If you had a really, really super good credit score, maybe they would offer you a 0% interest loan for short term, maybe, and if it's not quite as good or it's a longer term, they're going to offer you, a case where they would charge you some interest. And here they're showing as an example, 15%. And they're telling you what the number is, how much interest you're going to pay, et cetera. It looks to me also that, how this works is they kind of are focused on kind of shorter term. I don't know, when I look at it, they don't seem to have much over a year, but that could be wrong. Maybe they do offer longer term credit, but it could be that they, want to minimize the risk. And, if your person, usually here's the problem. I go there and I'm buying a chair. Here, let's look at this example. I'm going here, I'm buying a chair for $500. And if I don't have the $500, if I don't have a credit card where I can pay it off every month, what's the benefit of using a company like Affirm? Well, usually for most people, it's like, look, they're kind of stuck, right? The issue is that, look, they don't have good enough credit. Their credit's crappy, so they're going to try to go to use Affirm. Now, of course, they're going to check the credit score, everything like that, but maybe they'll offer this company would offer the credit. So this is what, buy now, pay later. Some of these, companies historically have been, pretty horrible because they charge high interest rates. I don't know about this company. I'm not saying anything about that. But this type of thing is like, look, it's a wonderful example. You're buying a chair for $500. If you can't afford the $500 for the chair, you shouldn't buy the damn chair. It's really that simple. Okay, but let's get away from that and let's go to the most recent here. So basically, they had reported earnings this week. It just happened, I think it was on Thursday or Friday, Thursday afternoon. And they did this deal where they accidentally released them early. So here we could just review this on Yahoo. Company shares plunged 33% after it reported results. Revenue forecast missed some estimates, blah, blah, blah. And they also had this thing where they released the earnings a little bit early, or some allusion to the earnings early on Twitter. So let's do this. Let's look at the fundamentals and try to get an idea what's going on. But first, let's look at the chart. So now here's the chart, AffirmFundys. And just to keep in mind, none of this is financial advice. This is just my analysis I do for me, sharing the way I look at things. You do your own research. So this actually, looking at this, this is a relatively new IPO. It came out in January 2022. And this stock was definitely, at some point, it was a high flyer, that's for sure. But now it's kind of it's given everything up. So basically, IPO'd over here, January 2021. You had this really huge, I'm on a weekly, okay, hugely weak. And then it pretty much sold off right away the whole time from that IPO. But then over here, what do we get? We get our wonderful W again, and we break out of the W. And we have a nice run to new highs up in the 170, probably touch 170 there. And then since then, it's just sold all the way down, and now it's actually below the IPO price. So one of the questions is, I know this is one of the ones that me, Kevin, had been watching at one point, and he was doing some buy the dips on this, maybe a few months ago. But let's see if we can look at the earnings, and we have the updated earnings that were just came out. And let's see if we can look at the fundamentals and get a kind of ideas like why this thing might be selling off like this. What the heck is going on? Okay, let's switch. Okay, so we're going to go to the spreadsheet. So the first thing I'm going to do is I want to just look at the balance sheet. So this is important to kind of, what I'm doing is I'm doing quarterly. So I'm looking at the quarterly filings. So that's for 3 months. And then when you're looking at the balance sheet, what we're doing is we're looking at a snapshot of on that date. So that this amount of money, cash equivalents, is exactly on December 31st, 2021. That's what the number was. Okay. So we can see here that looking quarterly, they had this is in thousands, so they had 1.6 billion of cash. It went down a little to 1.4, and then came back up to 2.5. So plenty of cash, it seems, on the surface, right? 2.5 billion. So that doesn't see an issue. And some of it restricted. Okay, fine. Securities held for sale. There's some of that. Okay, all that. This is an interesting one, row 7, loans held for investment. So kind of keep this in mind. They're sitting on, 2.1 billion, 2 billion, 2.2, 2.4 billion of loans held for investment. So what does that mean? That means that they're writing these loans, these 1-year-ish loans, as we were looking at, 3 months, 6 months, 1-year loans. They're sitting on most of these. They're sitting on these. Now, they are selling them, but they're pretty much sitting on them. Now, so therefore, what that means is they do have the credit risk. If those people do not pay, they will take losses. Okay, so speaking of losses, allowance for credit losses. So what they have to do is they have to estimate and say, hey, what do we expect? How many of these loans do we expect not to get paid back? And they have to estimate. So here, 113 million, 117, 152, and they're up to 158 million. So that's not that bad, probably. It's not particularly alarming. The loan loss amount they're allocating more. What's kind of interesting, the number of loans they're holding as compared to a year ago, looking at that date, it's not that much more, really. It's not a year ago, it's 3 quarters ago. So it's not that, it's a little bit higher, but not much more. So now let's look at the income. Let's see what's going on. So if we look at the income, we have their income statement, and I have 2, 3, so I have 5 quarters of income here. So we're actually looking December 2020, and we can compare it to the most recent quarter that they just released. And then what I've done is I've done a vertical analysis. So what I've done is taken, for example, we have revenue, and all your different items of revenue, and then you have your total revenue here. Net, meaning that there's some of these, they do take out the expenses. So it's the total net revenue. Then you have your operating expenses. These are all your different type of operating expenses, giving you total operating expenses. And then this will give you your operating loss. And then they have to account for some other things in here. These don't have as big effect on it, but there's some effect on it. So now we can see what's going on. So if we take a look at this, let's just look at the total revenue. So we had 204 million, went to 230 million, 261, 269 to 361 million. So they are growing, right? The top line net revenue is growing. Note there's seasonality. So a good thing to do is we can compare year over year. Notice that, holiday sales would affect this a lot. People doing pay later for Christmas gifts or whatever, holiday shopping. So this year, they had 361 million as compared to 204 million. So that's a decent return. Now, when you look at where is the revenue coming from, you have merchant revenue, virtual card, and then total network revenue. So 43% is what they're calling network revenue. Okay. And then interest income is 38%. And then they are selling loans, and they have 16% on loan sales. So what does this mean? So the network revenue is, I believe that's going to be the revenue they're making on their network, however that's working. So I guess when they get the button, they're probably getting revenue, blah, 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 somehow by doing that, by offering it. That's almost half their revenue. The other thing to note is that they're almost half, 38% of their revenue is actually what? What is that revenue? It's actually interest income. So these guys are very much like a bank. They're making almost 40, 38, 40%. And we can go back to the previous quarter, 44%, 40%, 41%, 30. A lot of that is interest income. So they're making money on that. So that's good for them. So you can see where, like on the example page that we had from that 15%, 30% interest rates, they can make some money on that. Gain on sale of loans. So that's a significant portion here too, 16%, 11%, 16%. So they are selling the loans. They're able to make the loan, initiate the loan, and they're able to sell it and make some profit on that. And then servicing income is very small, but they are getting some servicing. And that's kind of interesting. So do they count servicing income from loans they wrote? Or are they doing some servicing for other people? Don't 100% know. But the interesting thing here is they're losing money, right? So now we go to our expenses, and we notice we have our operating expenses. So 18% of their expenses. So what you do is we say, okay, 65,000 was 65 million is as a percentage of the total expenses, right? I'm sorry, as a total of the total revenue, you can figure out how much, how expensive the revenue is. So 18%, they're spending 18% on loss loan purchase commitment. That's a lot of money, but $65 million, when they go to purchase something, they're losing money somehow. Now, credit loss, they're provisioning 52 million of the 361 million, 15%. In this particular quarter, they're setting aside for losses, credit losses. They have funding costs. So this might be whatever, processing and servicing, 12%, technology and data, 26%. So the spending money, this would be an area where you're saying, well, they're spending money to build the company, make things better. Okay, they're spending that kind of money. 26% this quarter, 29, 27, 43%. Now, see, this is interesting in 20%. So during this particular quarter here, the March quarter, they were spending a lot. They were actually spending more in absolute numbers, but as a percentage of the income of that time, it was a significant larger percentage because the income was less. And then you go over here, SG&A is like 40%. So once again, though, total operating expenses, 557 million is 154% of your 361,000. So you're losing money. So minus 54%. So what you have here is you have a money losing company. You have a company that's got high expenses that are significantly exceeding the revenue that they're making. And so this is creating kind of an issue, right? They're not making money. They have not figured out a way to make money in their business at this point in time. Now let's look at a chart here. What I did here is I'm showing the total revenue in blue. These are the bars in blue. So you can see the revenue is going up, 204 mil, 230, 261, it's set up to 361 million. And, that's a decent jump, from the previous quarter, but year over year, it's a decent jump. You're talking like an extra 1.6 million on that. That's a decent growth year over year on that. But one of the issues is that in red, total operating expenses. These are 230, 400, boom, boom, boom. Their operating expenses are going up, and it may very well be that their operating expenses are going up faster than their revenue. Okay, that's what it looks like. So take a year ago, this may be a little hard to read, but they only lost $24 million, right? They only lost 24 million. And then here they lost 244, 126, 310, and here lost 158. So what's interesting is you compare a year ago, they only lost 24 million. On that quarter, this quarter, they lost 158 million. So one of the issues that you have is they're losing money faster. Right. So I say that again, they're losing money faster because they haven't worked out the issue with the operating expenses to make the business profitable. So therefore, they're losing money faster. So this is one of those dangers. So now you can see, why would the company sell off? Well, it would sell off because, you coming out and you raising money somehow. Now, I haven't looked at that and where the money's coming from, but since we know we have operating losses, the money isn't coming from operations. So it's got to be financing, whether that be stock, debt, or whatever. You know what? I didn't even look at the cash flow. I don't even really care. They have cash, lots of it. I can see they're up to 2.5 million, but where did the 2.5 billion in cash come from? Well, it had to come from financing as compared to the previous quarter. So we just know that is there. So go ahead and, look that up and figure out where the cash is coming from. But it's not healthy. I mean, obviously they're getting cash from financing. to cover up, not to cover up, it's not cover up, but to cover the losses so that they have money to operate. So what I did now is I did operating expenses in the most recent quarter versus a year ago quarter. And so what we're doing here is a pie chart. We're saying out of all the operating expenses, you can see that 25% of those is SG&A, 26% sales and marketing. Loss on loan commitment is 12% of, and this is percentages. Okay, this is percentages of earnings. Okay, so this is relative percentage of earnings. So just kind of keep that in mind. It's not percent of the total cost. So what I'm showing is as percent of earnings. So it's part of that vertical analysis. So let's compare it to a year ago. Well, a year ago, they were only spending 18% of their revenue on SG&A and only 70% of the revenue on marketing. So those pies have gone up. And keep in mind that the revenue on the most recent quarter is much higher than a year ago quarter. So they grew the revenue, but they also grew the amount they're spending at SG&A and sales and marketing as a percentage of that. So that's an absolute, and as a percentage of earnings, they've increased their spending a lot. Now, interesting, technology and data analytics, they've kind of held that constant, 18%, 17%. So their spending on the technology is consistent amount of their revenue, okay? So see, that's one of those things you look at, you say, okay, they're continuing to commit money. But if your excuse for them losing money is that, oh, they're investing in the business and they're investing in the technology and they're investing to build the business, that may not be happening here. SG&A may not be, some of it may be, but some of it may not be about investing in the business. Data analytics technology, that's investing in the business for sure. Some of SG&A is maybe, and some of it not. Sales and marketing, okay, that is investing in the business. You're trying to grow the business, you're spending money on marketing. I got you, I hear you. But some of it going to SG&A, whose pocket is that money going to? I don't know. Funding costs, 5%. What's interesting here, loss on loan purchase commitment, 30%. 29%. So here's what happened is this number is very consistent from a year ago quarter to this quarter, but they made more money. So it was only at 12%. So going back to the big picture, looking at a year in one quarter worth of income statements and looking at the balance sheet and theoretically the burn rate here, a couple of conclusions that I see, and this is not financial advice, this is just my view on it. My view is that, hey, look, they got plenty of cash. I don't see an issue there, right? There's not a going, in my mind, there isn't any kind of an issue of them running out of money or having any issue. Another thing to note is they're holding a lot of these loans. They're not selling a lot of these loans. So they got 2.5 billion cash, 2.4 billion of loans loaned out. So, I mean, most of the cash is essentially leveraged out. The other thing is, yes, they are growing the earnings, but they haven't worked out the cost structure because as they grow the earnings, they just lose more money. That's at least what this is kind of showing. And so you have another company, the one I did before, Shift Technologies, that one, it's another company that one of the issues they're having is they got to work out the cost. They got to work out the expenses of the business. They have to figure out how to actually make money. So it's more important than just growing the business, taking this top line number from 204 million to 361 million a year. Great. But your loss just went from $26 million loss to $196 million loss. Remember that loss, all other things being equal, you got to go get that money from somewhere. Where are you going to get it? You're either going to use debt, you're either going to issue more equity. And that's something to keep in mind. If you're one of these buy the dip people and you're looking for fast growth companies and all that, keep that in mind. Companies like Tesla, they've, historically, they've issued a lot of debt. They've issued a lot of debt, but they've also issued a lot of equity. And that equity, when they issue that stuff, it's diluting your interest. Okay, so you want to keep that in mind. So that's what I see here. This is another company that's struggling to get the recipe right. All right, that's it for this one. Hope that was helpful.